But the two things that really jump out to us, or maybe three, is that the performance of beta is in the 99th percentile historically. That's 25 years worth of data, which just says on a rolling 65-day period, you've never had high beta names outperform low beta names to this extent, other than 1% of the time over that 25-year period. So beta high risk names, if you will, have done extraordinarily well, and we always get a little nervous when we're up in this 90th percentile because it is the point where we should anticipate reversion for that factor. It's not for the market, it's for that factor. The same thing with value. Value is actually in the second percentile. In other words, cheap names have underperformed expensive names as much as they have at any point in time, other than 2% of the time historically. So value's actually been an anchor around bulls necks here. That tends to actually also not be much of a market call, but gives you some sense of the extremes, particularly as we head into the new year, particularly as we head in to a market that also has a relatively elevated sentiment environment. Welcome to RenMac Off Script. We're going to discuss markets, economics, policy, history, and life. It is the 13th of December. That makes it Friday the 13th, 2024. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We're going to talk a little bit about inflation this week, talk about the confirmations, some of the fiscal issues as we go into 2025, some of the factor work from a market perspective, China, a little bit on some of the sectors as well. But Neil, first question, you're a Jersey guy. You seen any UFOs over there?
I have not, although my ring alerts are all like lighting up like every night with drone over Midland Park, drone over. I mean, these are all like towns not far from where I live. So, yeah, I mean, there's something going on. I don't know what it is. I mean, it'll be nice if someone actually figures it out. But
Yeah, it's
yeah,
pretty.
I mean, it's definitely something that people are talking about up here.
I mean, what else is there to talk about, right? It's Jersey.
We could talk about how the Knicks got booted out of the in-season tournament by
I
the
forgot it's
Atlanta
basketball
Hawks.
season. Oh, you can't happen fast enough for you.
And
Unbelievable.
I think people are excited about, I mean, maybe Tommy DeVito starting another game for the Giants. We've been talking about that too. So it's not like there's nothing going on in Jersey.
True. Fair enough. Well, if you're not a YouTube subscriber of ours, hit that subscribe button. You can be alerted when these things post. But let's start with inflation, because it was a big week for inflation. What are the numbers? What's the skinny and any impact that it's going to have on the Fed?
Well, the probabilities of a December rate cut went up after the sort of deluge of inflation data. Remember that with inflation, there's sort of, multiple ways of looking at the same concept. So we have the consumer price index and we have the personal consumption expenditures price index, which is the Fed's preferred measure of inflation. But there are differences of weight and scope. But what's important is when you take the inputs from the consumer price index and the inputs from the producer price index, it basically tallies up to a 0.1% month over month print for core PCE. And that's going to be coming out next Friday after the Fed meeting. But it's probable that the Fed already knows, I mean, they have a very strong forecast. And so they probably can make a reasonable estimation for what the number is going to do. So, based on our work, it sort of adds up to around 0.1%. It'll round down to that. And that annualizes to less than 2%. And I think this is notable because it just shows you that there's a wedge that's growing between CPI and PCE. And that's something to keep an eye on for Fed watchers, market participants. But generally speaking, I think the core PC number for November is going to come in good. Sort of renew a little bit of confidence that we're kind of making progress towards 2%. But I've long said like the you need to have a framework, right? I mean, to think about how inflation works. And I would just say that there's a lot of I don't, I mean, it's hard to describe. There's a lot of expectation that inflation is going to be sticky for reasons unrelated to the data at the moment, right? It's sort of like, well, there could be tariffs. Well, there could be fiscal policy. Well, yeah, but none of those things have happened, right? Let's talk about what's happening right now. What we know about what's happening right now is that wage growth is slowing, labor markets are cooling, and we know that rental inflation is normalizing quickly. I mean, that was the big information bit that came out of the inflation data was that, rents after a long while, I mean, the sequential print basically looks normal now. And, there stands to reason that that probably continues. And you can tell a very good kind of story for why rents will continue to remain weak. What you can't do is really tell a good story for why some of the things that went up will keep going up. Like, tell me why used car prices will keep going up 2% a month, or lodging away from home going up 3% a month. I mean, these things are highly unlikely to keep happening. So it just tells me that, the lion's share of the inflation story is improving. And I think that's important. And at the same time, unit labor costs have slowed. So where's the inflation coming from? Do you think there's a supply chain crisis? Do you think that inflation expectations are coming up? Because, surveys and markets disagree with that. So it's just sort of, yeah, I mean, I would just say relative to the consensus, I think there's a little bit too much optimism around growth and a little bit too much pessimism around inflation. And that leaves me somewhat optimistic on 10-year yields. I mean, you can speak to this, Jeff. I mean, look, market probabilities for December have gone up. Longer term rates have gone up this week. And look at what's happened to housing stocks. Like if the
Right.
Fed can't get housing to work, they have a problem, I think on their hands. So yeah, I mean, I think the economy is not nearly as strong as people are making it out to be. And with the labor markets cooling, that kind of puts some downside risk to the consumer, because the
Yeah.
consumer is really the only thing that's holding things up at the moment.
Well, our market cycle clock is consistent with your thought there, which is, inflation is probably better than people are talking about, and growth is probably cooler than people are discussing and talking about. And the good news is, the irony there, is that tends to be a pretty good zone for equities historically. Tends to be a good zone for consumer discretionary stocks, not the big ticket items like you're hitting on, with housing, with some of these other purchases, as the Fed is able to obviously get a little bit more air cover, if you will, for the data, to take down rates. So I think that ends up being pretty good news. I want to talk about the factors a little bit, but Steve, let's talk about what this impact might be if we have softer yields in the bond market. What's that impact on the deficit, and how Washington thinks about the data?
Well, I mean, I'm thinking about, with Neil talking about the Fed lowering interest rates, and we've done that a few times this year. So you talk about what the cost of servicing the debt's going to be next year. Maybe that goes down a little bit. Sounds like a lot of corporations are reporting good profits. The stock market's gone up, so I'm anticipating maybe revenues will increase next year on the tax side. So as Republicans sort of contemplate what they want to do here, that's probably going to be encouraging if they want to maybe go a little further on the tax cut side. And I think you raise an interesting point about the from a treasury perspective. When Scott Bessent comes in, he's going to have to find buyers of this debt. I think he's going to have to probably find longer duration buyers, because it seemed like Treasury Secretary Janet Yellen was maybe intentionally doing shorter duration at lower rates to try to boost the economy ahead of the election. So he's going to have to wrestle with that. That's a really important part of the job that I think often gets overlooked. But in terms of a political, I guess, perspective for Republicans, look, if the cost of service, the debt goes down, and you have additional tax revenue, that may provide more incentive to be a little bigger and bolder on their reconciliation approach.
The idea that the Treasury does not have well, it's usually the function in the CFO office of the treasurer to kind of manage the duration of the corporation, right? The idea that the U.S. government just kind of puts it out there and doesn't think about, should we extend duration? When we had rates that were basically zero around COVID, and we were looking at COVID relief. I mean, those are long duration liabilities, right? That were for long-term projects that matched. And why would we fund that with short-term debt? I mean, that is absolutely asinine. And there's not a single person in corporate America who would have kept their job for 3 months under those kind of circumstances. It was unbelievable. And I think that's something that Besant has talked about, which is, let's look at this from a pragmatic standpoint of matching these projects with the debt that we're going to incur to ensure that we've got this match, right, between basically in corporations it's asset versus liabilities. I don't know how that works exactly for the U.S. government, but obviously the projects have long duration to them, and that should be matched by the debt.
I agree, and I think his prior experience, and familiarity with other countries' governments and their currency situation. I mean, I think he's going to be able to hopefully use those relationships and experience to hopefully find some buyers of this debt moving forward. So I think that's all a positive thing for all of us who live here.
And I don't know if this is your bailiwick or expertise, or if you even want to hit on it. But it feels to me like the Syria situation, this fall of Syria and the Assad regime, is really potentially a great opportunity, but at the same time a potential big problem, right? I think it does show the underlying weakness of Russia and Iran,
Mhm.
both with huge vested interests in this power vacuum that's now developed. How aggressive? And I know Trump has come out and said that's not our place or our problem. Um, but I got to think we could use it to gain leverage in the Mideast, and more specifically, gain leverage over both the Iranian regime and Putin. I mean, they've got bases there, they've got a warm water port there. It just feels like something that we should be sticking our nose in versus walking away from. What are your thoughts there?
Well, I think you're right to point out that it's an opportunity for the U.S. to sort of, replace the Assad regime with a more friendly regime to us. I think what you may have seen indirectly is sort of allowing Netanyahu and Israel to go ahead and eliminate some strategic threats to them that I guess or probably strategic threats to us as well. I think you're right also to point out the fact that its weakness and inability from Iran, obviously dealing with the more or less defeat of their proxies and declining influence there in the region in the Middle East with their situation with Israel, and then Russia focused primarily on Ukraine. I mean, they're not able to come to the assistance of their allies. And when you think about Trump coming in and what the appeal is going to be to some of these sort of, I'd say folks sort of in caution to the, blowing which way the wind's going to blow. If you're China and others trying to pull these countries away from the U.S. sphere of influence, just watching how fragile Russia and Iran are, that may make you think it twice. And I think of Turkey. I think they were sort of the backers here of HTS. I'm not sure what this can mean for the Kurds there. So that's something to watch moving forward. But overall, I think it's probably an encouraging development for the U.S. just to make sure that it stays and goes in that direction. I think my fear is, there's a lot of optimism when expressed by the Biden administration when they pulled out of Afghanistan that, oh, the Taliban was making all these promises. And if you look at the current situation there, I don't think they've lived up to many of them. So, be careful what you wish for. But I also think moving forward, sort of related to Israel and Iran. There was an interesting report this morning, recording this Friday, from the Wall Street Journal about Trump and his team considering the options to deal with Iran. And part of it's either the U.S. either directly or indirectly through Israel, sort of taking out their nuclear capabilities. And I think that's going to be the thing to watch is can you sort of work with Israel and Saudi Arabia now to revive this Abraham Accords and really isolate them. And so I think that's something to watch moving forward. From a market perspective, are they going to see sanctions actually enforced this time on Iranian oil as well to prevent it from basically right now they're subsidizing China with cheap energy. So it wouldn't surprise me if that gets addressed at some point too.
So how do we just leveraging that? I mean, the one thing that Trump is always good at is finding the pressure point and then, what that fulcrum is, and then just applying the biggest stick to that fulcrum, right, to get the maximum amount of leverage. And it certainly feels like Syria is one of those. So him walking away seems to be kind of inconsistent with that. I guess he would address that through the proxies, and I guess his two real choices are backing Turkey and or backing Israel in both of those. But that also brings me to kind of this question that the media has been asking, which is his invitation to Xi to come over for the inauguration. Hey, I'm having a birthday. You want to come? So what's the thinking there? I mean, I always feel like he's got motivation, but is this really, is it just inviting him to his own birthday party, or does he really want to use this as a leverage?
I think it's more the latter. I think part of it too, Xi, I'm sure wasn't expecting it either. So just to sort of catch him off guard, which is something that the Chinese candidly don't like being put in that position. So now it's sort of, just putting him in that awkward position. What do you do? Does Xi come? Does he not come? Does he look weak if he does? If he doesn't come, does he sort of give Trump more invitation to move forward on the tariff push? Who knows? I think, Trump just likes putting people in an uncomfortable position, sort of thrive in the chaos. I wouldn't read much more to it than that. When I think about the tariff situation, though, people trying to price this in, I think this probably suggests to me that, Trump may be looking for a way to negotiate some things earlier, maybe put off the tariff pivot at some point. It's going to come, it seems, again, at some point. Maybe it's just not earlier with China. And that's sort of what happened. If you look at what happened the first time during his administration, it was a desire to sort of shore up relations with Canada and Mexico to sort of that strong position here before we sort of pivot to the issues there with China. So it could be some of that. I think, too, Trump apparently reported he's going to extend invitations to some other world leaders as well. And if they start to come and Xi doesn't, what does that mean? Is Putin going to get one? Who knows? But it'll be interesting next 4 years, if nothing else.
I mean, just to watch the media lose their mind is going to be worth it. I don't care who it is. Well, from a market perspective, a couple things really jumped out to us in the last week or so, and the first being the factor work. We look at all these different factors, and I'll put it up on the screen here, but you can see that we'll measure over basically the last quarter what the performance of different factors has done, right? So if you think about something like beta, high beta names versus low beta names, something like value, cheap names versus expensive names. And we do the sector neutral. So we take out the influence of dominance of a single sector. But the two things that really jump out to us, or maybe three, is that the performance of beta is in the 99th percentile historically. That's 25 years worth of data, which just says on a rolling 65-day period, you've never had high beta names outperform low beta names to this extent, other than 1% of the time over that 25-year period. So beta high risk names, if you will, have done extraordinarily well, and we always get a little nervous when we're up in this 90th percentile because it is the point where we should anticipate reversion for that factor. It's not for the market, it's for that factor. The same thing with value. Value is actually in the second percentile. In other words, cheap names have underperformed expensive names as much as they have at any point in time, other than 2% of the time historically. So value's actually been an anchor around bulls necks here. That tends to actually also not be much of a market call, but gives you some sense of the extremes, particularly as we head into the new year, particularly as we head in to a market that also has a relatively elevated sentiment environment. Now, volatility, which is interesting because the difference between volatility and beta is one is associated with the market, how volatile am I given the market's return, and that's beta. Volatility is just plain standard deviation. How volatile am I regardless of the market's returns? The high, we're in the 96th percentile for volatility. But what's interesting is we do not tend to see that be a bearish influence for equities. In fact, if anything, when volatility is outperforming, it tends to be good news or bullish for equities. So that has a 3 to 6 month fuse to it, which is good news and gets us into a position that probably more than anything keeps us in a pretty good spot for the first half of 2025. We'll watch that. We've been leaning more towards cyclicality. We did lean towards beta. in the fourth quarter. I don't know that that's going to work in the very near term as we turn the page into the beginning of the year, but certainly it's not enough for us to get bearish. One of the areas in the market that I do think is starting to improve and will be important to watch is discretionary. We're seeing some of the apparel names improve. We're seeing some of the restaurant names improve. Some of these discretionary spends, if you will, and that's an important part in our market cycle clock. That's usually the area where we tend to see the most consistent performance is in discretionary names. So like what we're seeing there, and I would just also add, people have asked about our China call. We are still bulls on China. We are committed to the China call here. Nothing has changed. In fact, if anything, we continue to see evidence of our thesis, which is their 2008, 2009 moment. Their Mario Draghi, if you will, do whatever it takes to make sure that they keep their house in order. And usually that's a bout of incrementalism, right? In 2008, we started with the TARP program, and then incrementally we kept adding to the system until it finally got some traction. And we suspect the same thing is actually happening in China as well. With that, Neil, what's happening next week in terms of the data?
Well, there's quite a data deluge next week ahead of the holidays. So just first on the data, retail sales will be coming out. This will be a November data point. Remember that October was softer, so I think the consensus is kind of looking for a bit of a rebound following that weak October data point. Generally speaking, we did see core goods inflation perk up, and because retail sales are kind of a nominal data point, there's some reason to assume that you do see a rebound in November. We'll also be getting data on housing starts. I think that's important for the reasons I've been talking about. Is basically, you do have unsold completed inventory of new housing surging over the last year. It's up almost 50%. So it sort of begs the question why single-family construction would actually perk up. I don't think it would. And we know that construction is probably going to continue slowing for the multifamily sector. We'll end the week with core PCE. The consensus right now is at 0.2. I think it's probably still early. You haven't had all the people in the consensus kind of coming in yet, but I think over the weekend that probably comes down to 0.1. And then we have the Fed meeting, and it's a big one because they're expected to cut, but I think the story is really going to be how they guide for next year. And I think you'll probably see some cuts coming out in 25 and 26. And maybe that's conditioned on them, revising up their growth and estimates, or maybe lowering unemployment or something like that. But, in my mind, it's not really so much them taking cuts out. It's really about the distribution of cuts and the timing. And I think, maybe the markets are right. There will only be 3 cuts next year. But what if the cuts all come before July? I think that's the risk scenario that people aren't really considering at the moment.
Yeah.
So whatever pause everyone's kind of playing for may well be short-lived, because inflation will continue to slow and there will be pressure on the labor market. And all the sort of things that people are worried about, broad-based tariffs and deportations and labor and all that. I mean, that doesn't happen right away.
Right. Steve, what's happening on Capitol Hill next week?
Lawmakers will race to avoid a government shutdown on Friday. I don't think there's a risk of a government shutdown. I think we're pretty much set here for a March stopgap. We should get the text on Sunday to sort of go ahead and confirm that. The Senate will also pass their defense bill that the House cleared last week. I know majority of House Democrats didn't support the bill. I don't think that's really at risk of tanking it here. Schumer's bringing it to the floor anyway, so I wouldn't read too much into that. And then I'm going to watch as Trump's nominees continue to meet with senators this final week here. It looks like RFK Jr. will be going up there for the first time. Sometimes we get some headlines around the policy. One thing to keep in mind about some of his desired policies here with respect to processed foods is there may be some overlap in terms of jurisdiction with the Agriculture Department, and that's where Trump named Brooke Rollins, somebody who worked with him previously at the White House there. So the jurisdictional push and pull is something to keep an eye on. And just where we are a week now as opposed to where we were a week ago. You look at Pete Hegseth. He's somebody whose confirmation was looking very much in doubt at one point. Seems to have gone out aggressively fought for it, something that appeals to President-elect Donald Trump. And I think the message has been sent directly or indirectly to senators, sort of get in line behind these folks, or we're going to pressure you through Trump and Trump's allied sort of groups there. And that message seems to be working, because right now you don't really see any Republican senators opposing these nominees. We'll see how they perform in their hearings. That's something to be really important to watch next year. But right now, that's probably a good sign for Trump and his selections.
Well, we're here closing out the year with 2 weeks left. These tend to be two pretty good weeks for equities, so I don't think you want to step in front of that. 5,700 is support on the S&P that is going to extend beyond obviously the calendar, so that's how we're thinking about the world. Our market cycle clock says about 15% returns for next year. That seems about right. We add and subtract different factors around that. Obviously, with the Fed cutting rates, we're in an easing cycle that tends to boost it a little bit. We also have sentiment, which is a little aggressive, that tends to take away a bit. So 15% is in that camp that puts it right around 6,900 on the S&P. There will be some wrinkle, and that's what's going to be interesting to try to figure out. Do we have weakness ahead, which tampers some of that sentiment, and then have a strong second half, or do we end up with a more modest second half in terms of equities? What I would say from a seasonal standpoint, particularly around a presidential unification government, the markets tend to be strong between the election day and the inauguration, and then soften a bit versus Democrats, which tend to be soft between the election and the inauguration, and then start to go. So for whatever reason, there's a little twist there in terms of the seasonality based on the unification. So this would be the former, not the latter, but we'll watch that. 5,700 again, important support for the S&P. 10-year yield, 450 is resistance. 404 on the downside is the first support level, taking all the way down to 360 if we get below that. But I'm with Neil that I think we can see better conditions for a better, more improved bond market, i.e. lower yields, as we get into the first of the year. Well, join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on YouTube and join us at RenMac LLC on our Twitter account. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.